What kind of decade has the world of finance just stepped into? Is it going to finally put the shadow of the global financial crisis behind it? Or is there a whole new series of public policy challenges that are quickly approaching? Welcome to the 20s. It's a brand new year and a brand new decade, and one of the first questions on our minds now is what new risks financial sector leaders have to understand to make a success of these uncharted waters. I'm Scott Martin from Deloitte Centre for Regulatory Strategy, and you're listening to Regulated Radio. We've got an all-star lineup of veteran guests today to talk about the year ahead. David Strachan and Andrew Bulley are here to take us through the regulatory outlook for 2020. And we're also joined by Ian Stewart, our chief economist, who is back to give us the latest on the trends he's seeing in the economy and in markets. We'll be talking about the economic and social environment that regulators will have to consider when making policy this year, how fast-emerging issues like sustainability are affecting the regulatory agenda, and how regulators might try and get ahead of a new wave of digitalization to reduce the risk that something along the way goes wrong. This is our first podcast in the year where we clearly haven't run out of things to talk about, and probably never will. This is Regulated Radio. I always find that the start of the new year is a good opportunity to take stock of big global trends and ask whether the year that we're just beginning is going to be one of continuity or one of really important change. You could say that 2019 in some ways left us on a bit of a cliffhanger. The political risk that's been roiling markets isn't yet resolved. The question marks over a long but tepid economic recovery haven't gone away, and the unfinished business of financial policymakers is a list that just seems to get longer. What this means closer to home, of course, is that we've got lots to sink our teeth into on the show this year, and of course on the show today. Now, as mentioned at the top, we have three fantastic guests with us. So to kick things off, I'd like to bring in Ian Stewart. Ian is Deloitte's UK chief economist. He's the publisher of our CFO survey of business sentiment, and you last heard him on Regulated Radio talking about the economic outlook back in March. Ian, welcome back to the show.
Hello there.
So, Ian, it's clear that the performance of financial markets and the performance of the economy are really critical inputs into the performance of financial sector firms. That being the case, what's your outlook for the economy in 2020, and where do you see the biggest risks for financial services firms?
Well, I think the starting point is to consider that we have just come off the back of a marked slowdown in the global economy in 2019. And it was a slowdown that everyone expected to happen, but it came faster than expected. And it was driven by protectionism, which proved more toxic, more disruptive for manufacturing, exports, and investment than expected. And it hit the German economy particularly hard. I mean, quite extraordinary. The German economy, which 2 years ago was the poster child for growth in Europe, came close to recession in the latter part of 2019. Well, I think for 2020, the outlook, I'm afraid, is for more of the same. I think sub-trend global growth. I think if there's good news, it is that the risks of a recession in the West, which looked quite high over the summer, I think have eased back. And that reflects the fact that central banks last year surprised markets by easing policy. So the European Central Bank and the Federal Reserve, that's buoyed equity markets and it's eased financial conditions. And I think that's somewhat reduced the downside for global growth. Now, there's a really mixed picture across the world. I think for advanced economies, the rich world, growth is going to slow a bit, and that's mainly about the US slowdown, which is gathering pace. Europe, I think, will track sideways. It depends a lot on which country you're talking about. Actually, the Italian and German economies are probably going to pick up a bit, but they are growing at very low rates. France is more resilient because it's more dependent on domestic demand. But overall, the euro area, I think, is going to track sideways. UK soften a bit. Emerging markets outside China are going to pick up generally. China will continue its long-term slowdown. So it's a mixed picture, but if you put all the numbers together, I think what you're talking about is global growth of around about 2.5%, this year, which is pretty much what it was last year. In terms of risks, I think undoubtedly the big risk is geopolitics and protectionism, which proved really bad news for growth last year. I think that the US election at the end of this year is going to stay Donald Trump's hand on more aggressive protectionist measures, but I think protectionism is a big risk.
So Ian, maybe just expanding on your protectionism point, how do you see global trade tensions playing into all of this? And in particular, do you think we'll see a cooling of the trade war between the United States and China in 2020?
Well, trade has been a massive engine for global growth in the post-war period. So globalization, whatever its detractors say, has been hugely additive to global growth. So trade volumes have grown much faster than GDP growth decade after decade, and that has helped lift GDP growth and welfare, particularly in recent years in emerging markets. Last year, we saw trade in goods turn negative. Now, that hasn't happened since the financial crisis, and that was a direct result of protectionism, which started with measures imposed by the states on China and which has subsequently expanded. And I think that although the US wants to step back, and we saw this with the phase one trade deal they agreed with China in December, I think they want to step back from further measures because the US the President Trump does not want a fast slowdown in the US. It will be self-harming in an election year. But my view is the underlying tensions between China and the US are not manufactured by the Trump administration. There's a wider US concern in areas way beyond narrow trade, in particular over technology, but also in terms of military power and strategic influence. So my own view is that we should see 2020 as a year of somewhat reduced trade tensions. But I think we are in an era of slower globalization, where in particular this friction between the US and China is going to make moving goods, services, capital, and people somewhat harder. It's inelegantly been termed slowbalization by the Economist, but I think it's not the end of globalization, but it's a weaker pace of globalization.
That's very interesting. Now, I want to bring in David Strachan. David is the head of Deloitte's EMEA Center for Regulatory Strategy and was last on the show talking about our 2019 outlook and also our mid-year review. David, welcome back.
Thanks very much, Scott.
David, I think another angle to global trade tensions that we were just discussing with Ian is a more general retrenchment from globalization, or what Ian called slowbalization. How are you seeing this developed in the regulatory field? And particularly, is the commitment to the global post-crisis reform agenda still as strong as it once was?
Well, I think we need to remember that regulators have been on a long journey to complete the global post-crisis reforms. And I've said before, they've achieved a huge amount, and no one and nothing should detract from that. But, having listened to Ian and what he said about slowbalization and protectionism, I think there's no doubt that when we look at the regulatory world, there is now less support for international cooperation, and I think it's taking its lead from the political environment. And if you want evidence of that, you have the Financial Stability Board, which is clearly the architect of the post-crisis reforms, itself carrying out some work in 2019 on fragmentation, so divergence in national regulatory approaches, and what it can do to prevent it. So I think that tells us a lot. Having said that, notwithstanding that initiative, we don't see much prospect of the regulatory community rolling back what fragmentation has already happened. Things like the creation of the intermediate holding companies in the US, or the intermediate parent undertaking that's going to come in the EU. But I think there's still a really big prize to play for, which is to stop fragmentation becoming more widespread to stop further fragmentation, particularly in areas which really demand global coordinated responses like technology and like climate change. We'll come back to that. And then just to finish off, I think if we're looking for indicators, the two that I'm watching in Europe are somewhat linked. The first is really what happens in the EU in relation to its implementation of the final phases of Basel III, what many commentators refer to as Basel IV. How closely does that track or conversely depart from the Basel standard? And second, and that's really what happens with Brexit, which will take what was once a single market and an increasingly harmonised set of financial services regulations and split it. Now, as we sit here today, it's not clear how wide or deep that regulatory divide between the UK and the rest of the EU will become, but it's certainly something that I and many others are watching very keenly.
Now, for another really big 2020 trend, I want to bring in Andrew Bulley. Andrew is a partner in our Center for Regulatory Strategy, and you've heard him on the show before talking about things like conduct, culture, and value for money in financial services. Andrew, it's good to have you again.
Scott, good to be back here.
So, Andrew, in an environment with all these difficult external factors, whether economic or political ones like we've just discussed, or even technological, how do you expect regulators to approach holding the senior executives of financial services firms accountable for potentially the bad outcomes that their firms might create?
Yeah, I think undoubtedly strengthening the regulatory accountability of board members, key senior executives, has been one of the most important components of the post-crisis regulatory reform package. That reflects the fact that in past cases of prudential and conduct failure, it's often proved remarkably difficult for a variety of legal and operational reasons to identify where responsibilities ultimately resided within a firm. Now, the rollout of such regimes has been pioneered in the UK. We've had variants of the senior managers regime in operation for several years in this market, culminating in the full SMCR implementation at the end of last year, of course. But similar or analogous regimes have been or are being rolled out in Ireland, Australia, Hong Kong, Singapore, South Africa, to give some examples. Now, attention tends to focus on the enforcement dimension of these regimes, and as we say in the Outlook, where regulatory patience is running especially thin, as with financial crime, accountability regimes will no doubt be used as a very potent enforcement tool in response to any serious breaches. So I think the primary emphasis will be on ensuring that accountabilities are clearly defined, documented and understood, and most importantly, that they're operative in practice. And so inevitably, that will lead regulators to ask whether a firm has a strongly embedded culture of accountability in practice as well as in principle.
All right, so David, just coming back to you, very keen listeners to Regulated Radio will know that we in the Center for Regulatory Strategy publish a regulatory outlook every year at the beginning of the year. And we've just published our outlook for 2020 in the last few days. Can you tell us a bit about what sort of things readers can find in it?
So this is our EMEA Centre for Regulatory Strategy's annual big publication looking at the year ahead. What we're really trying to do is to inform the leader of financial services business understanding of how regulatory trends are going to affect them, their businesses, their strategies, and indeed amongst the many different regulatory issues where they should focus their efforts. Now, this year, for the first time, we've included a new section which looks at medium-term trends, and they include politics, technology, and social and demographic changes. And the reason we've included these is that as we look ahead beyond 2020 to the next 2, 3, 4 years, it seems to us that there are a number of factors under these headings of politics, tech, social and demographic changes that are going to have a huge impact on the direction of financial services regulation. Otherwise, the Outlook sets out a number of deeper cross-sectoral trends that we think are going to be important. They include IBOR transition, climate risk that we've mentioned already, good customer outcomes and the like. And as well as the cross-cutting themes, we've also got sector-specific issues on banking, cap markets, insurance and investment management. In short, there's something for just about everyone. I mean, one thing I would say, though, having reflected on the outlook since we published it last week, is that there's a golden thread that runs through many of the issues we identify, and that is data. Data's everywhere, from management information to monitor progress with IBOR transition, to understand your exposure to climate risk, to drive machine learning and artificial intelligence applications, and so on. I mean, it really does cut through and across a number of these issues. And I say that because it really confirms our view that for financial services firms, investment in their data capabilities is going to be critical for their future success.
So, as you mentioned, David, the outlook identifies some big thematic trends and some deeper regulatory initiatives that we're seeing emerge now. One that really stands out for me in particular is the big shift in regulatory attention towards the sustainability of the financial sector and the sustainability of what it invests in. How much pressure would you say that this is putting on finance right now, and what should financial services leaders expect to see in the year ahead?
Well, as you say, it's Scott. It really climate risk, climate change has shot up the regulatory agenda for very clear and obvious reasons. I think there's a really important political debate occurring now, which is the extent to which the capital framework for banks, or indeed for insurance companies, should be used to promote climate change objectives. And this is something, again, that we're looking at very carefully. Having said that, we don't think that regulators themselves are yet at the point of being convinced that the capital frameworks should be used to promote green objectives. So we don't see what are often referred to as green supporting factors, capital incentives to invest in green financing projects on the agenda very soon. And indeed, if we think that if regulators were forced to choose between green incentivizing or supporting factors and the converse, the opposite, brown penalizing factors, that they go for the brown penalizing factors. So that's a debate for the future. Here and now, we expect a focus on how financial institutions identify and manage the financial risks from climate change. And then picking up on Andrew's point, how they use accountability regimes in the countries where they exist to promote this. And we see steady momentum behind that. On the financial risk side, we don't expect regulators to rush towards prescription and prescriptive standards. There is, I think, a clear recognition that no one has all the answers here yet. And it will take some time, but clearly not too much time, for the right approach to emerge. And I think the Bank of England's recent discussion paper on the design of its first climate stress test is a good example of that exploratory approach.
Indeed. So, Andrew, just bringing it back to you, one of the four big trends that we talk about at the start of the Outlook is socioeconomic transformation, and especially the effects on the financial sector of an aging population and a changing world of work. What do you think are the most important trends for the sector to be watching here?
Well, Scott, I certainly agree. I mean, we identify those two socioeconomic trends you mentioned as key ones for both firms and regulators alike. Why is that? Well, I mean, both raise fundamental issues for regulators and firms around financial inclusion and hence potential vulnerability. On the ageing population, firstly, if we take the UK, the population of over 65 is expected to grow from approximately 12 million in 2016 to over 20 million in 2041. Now, that steep rate of growth raises profound issues around fixed income dependence, age-related illness, and hence the potential for vulnerability and exclusion will gain increasing significance. In particular, I think regulators are likely to look increasingly hard at whether new digital means of delivery are unfairly excluding older age groups, or perhaps being unfairly subsidised by them via traditional distribution routes. Now, at the same time, millennial workers are fast becoming the largest segment in the global workforce, and they also now form the greatest share of the emerging alternative workforce. So that means that there is a growing pool of consumers who are in temporary employment of some kind, on-call contract workers, freelancers, or what have come to be known as gig workers. But what characterises all those groups is that their income can be both volatile and unpredictable. So regulation, has always reflect the society in which it functions, and so regulators will increasingly focus on how the financial services sector is meeting the needs of these very different socioeconomic groups. And I think in particular they will challenge any unreasonable lack of accessibility or barriers to the products and services these groups need, and indeed also any unfair cross-subsidy between them.
And one of the deeper trends that you talk about in the Outlook, Andrew, is that regulators really want to see good customer outcomes arising from financial services, not just compliance with the applicable regulation. So when you were on the show before, I asked you if financial services supervisors were becoming price regulators. What's your latest view on this?
I remember that challenge very well, Scott, yes. In a nutshell, I think that it's more a case of they're becoming value regulators rather than price regulators per se. Price, of course, is an important component of value, but price and value are two very important different things. From a big picture perspective, the issue is the way that post-crisis conduct regulation has extended its remit well beyond sales, advice and distribution processes to embrace the economic outcomes consumers experience, particularly those consumers who are most vulnerable and therefore least able to protect their own interests. And in the UK, where the conduct regulator, somewhat unusually, has a parallel competition remit, this focus on economic outcomes has led to some explicit micro-price intervention. Payday loans is one example, and it is a growing trend. So, for instance, in the last few days, the FCA has just announced a consultation on compulsory minimum interest rates on savings. But I have to say, I don't see financial services regulators introducing wholesale pricing interventions of the kind that are routinely applied to, say, the utilities sector, for example. I think rather the overarching objective is, once again, to shift the governance, culture and practical mindset of firms such that whether their products are providing fair value to their consumers becomes a front-of-mind question for them at all times. And in that regard, we highlight in the Outlook how the investment management sector has been at the forefront of regulatory thinking in this area. And frankly, we expect regulators beyond the UK to be watching the development of this approach with very keen interest.
So, David, I think it comes as a surprise to nobody that we listed technological change as a major trend. And indeed, we've moved from a world of experimenting with novel technologies to one where those technologies are being deployed at scale and are changing the competitive landscape of the sector. So from a regulatory point of view, what do you think will be the biggest challenges for finance in 2020 when it comes to things like artificial intelligence and consumer data?
So, Scott, for policymakers and regulators of all kinds, the biggest challenge, I think, is going to be the need to respond to the pace and scale of technological change, what you referred to in your opening comments there. I think there are two related risks. The first is that regulation actually moves so slowly that innovation bypasses it, either largely or completely. And when you think of the pace at which the regulatory process works, particularly in the European Union, you can see that I think there's a growing concern that about the ability of regulation to keep pace. But there is another sort of converse risk, really, which is that regulation stifles innovation, and clearly that's an outcome that policymakers want to avoid as well. So the first challenge is really about balancing these two risks and coming out with a regulatory approach that keeps pace with what are often very rapid developments. The second is the absence of a global approach to or framework for these sorts of issues. It's not historically, technology has not historically been the territory of the Financial Stability Board or the Basel Committee on Banking Supervision, for example. Now that is changing, but in some respects it's got to change very quickly. Having said that, there is a sort of some glimmer on the horizon, and that was the regulatory response to the Libra Association's announcement, and indeed the whole tone of the debate about global stablecoins, where in that area you have seen finance ministries, regulators, central banks really around the world. Closer to home in financial services, the challenges are going to include the approach to the use of artificial intelligence and some of the ethical issues involved in that, and increasingly where to place the regulatory perimeter, which activities and entities fall within the scope of regulation and which fall outside that scope. And at the moment, there is clearly a particular focus in some parts of the world on the cloud services providers and whether some of their activities should be directly regulated. And the last issue I'll just mention is, clearly there is now a huge amount of personal data at the disposal of financial services firms. That's an enormous benefit and holds great potential, but there are also significant risks in there, and those risks will have to be managed particularly carefully. And following on from that, I think just picking up on Andrew's comments about value for money, we expect to see an increasing focus by supervisors on value for data. Are consumers actually getting value and benefit from the data they are sharing with their financial services providers?
So, David, one of the things that makes me think about is another one of the trends you identified in this year's Outlook, and that's how firms manage the resilience and security risks associated with technology adoption. In your view, is the regulation of IT risk in the financial sector going to be something that slows down how fast the sector can digitalize?
I wouldn't say it would necessarily slow down digitalisation. I think firms also need to tread very carefully here. Clearly they're incentivised to avoid major outages and data breaches associated with digital adoption and the loss of investor, public, and indeed, in some cases, political confidence that goes with them. It's also important to bear in mind that regulators are not only concerned about the risks that arise from digitalisation, they are also very focused on legacy systems and how robust they are too. Against that background, we expect supervisors to place more pressure on firms to address deficiencies in their operational resilience, including where they rely on third parties to provide them with their critical IT and other services. One specific focus here will be on outsourcing to the cloud, and in particular whether the boards of firms looking to outsource to the cloud have really engaged with all the business issues and risks. Clearly, and to state the obvious, outsourcing to the cloud is a critical technology decision, but regulators see it as far more than that and want to be satisfied that the board has really engaged with strategic issues and the risks arising from that transition and the resulting dependencies on the cloud services providers.
So, Ian, I want to follow up with you on this question of technology. And since you've been on the show before, you know that we always end by asking our guests to make a prediction. Now, a lot of people talk about an economic outlook of secular stagnation, persistent low productivity, low interest rates, and high debt burdens. What's the likelihood, in your view, that the kind of technological leaps forward we're seeing now in artificial intelligence, blockchain, quantum computing, that these might surprise us on the outside and lead to a much more positive economic outlook than what we're currently expecting?
I am an optimist on this. I think technology continues to have a significant potential to raise productivity. I don't subscribe to the view of the US economist and economic historian Robert Gordon, who makes, I think, an interesting argument that the kind of low-hanging fruit, the most life-changing inventions have already been banked, and what we're now getting is incremental improvements which are not delivering the same gains in efficiency and improvements in human welfare, which in the past have been associated with tremendous gains in GDP growth. So I don't buy that argument. I think there's a kind of conundrum about productivity and technology, which is that we see in our lives the transformational effect of technology on a kind of daily basis, and it's a subject obviously of we're all talking about with developments like artificial intelligence and robotics, but we don't see it in the productivity numbers, and I think that may partly reflect the inadequacy of how we actually capture GDP, how we measure GDP. But I am an optimist. I fear this is not going to race to the rescue of GDP growth in 2020, but I'm an optimist. And the other thing I'd say is that if you look at GDP growth and productivity growth in the very long term, look at the United States. The 1960s were a fantastic era of fast productivity growth. The 70s were pretty terrible. You got a revival in productivity starting in the 80s and culminating in the mid-2000s. And the last 10 years have been pretty poor. Even in America, where productivity growth has continued at a faster pace in the UK, it's been slower than we got used to before the financial crisis. So productivity moves in mysterious ways, but we should not give up the essential point that productivity growth does change. It responds to changes in the environment, to stable economic policy, to high levels of investment, to innovation. And I think one of the surprises, not of 2020, but of the 2020s, will be that we suddenly find ourselves dealing with faster GDP growth and productivity growth than we had expected. And that was certainly the experience from the late 90s into the early 2000s.
All right. Now, Andrew, it's your turn for the prediction. But thinking about some of the big trends influencing the regulatory landscape that we've identified in our 2020 outlook, which one of these trends do you think is going to prove the most challenging for regulators to successfully address in the coming year, and why?
Yeah, well, as you can imagine, Scott, we've given a lot of thought to this. And I confess what I'm going to say is not terribly original, but I think it's very important nonetheless. And it's really the recession, risk of a big financial event, turbulence in the market, as always, really, in regulation. And regulators always have to navigate a pretty difficult passage between ensuring that the financial services sector is prepared for a major downturn, should that occur, but without holding back either growth, which has generally disappointed over the last 10 years, or the ability of the sector to innovate to meet all the social and real economy needs we've been discussing today. Now, that's not to say that, it's our view we're about to tip into recession. As Ian said earlier, there's a consensus in the market that recession risks are actually perhaps reducing compared to 12 months ago. But, for several years now, commentators have been saying that we are in a late cycle phase. And yet, helped no doubt by unprecedentedly low interest rates, the developed economies have mostly continued to confound the gloomsters and avoid outright recession. But regulators, as a matter of professional excellence, they have to take a slightly less optimistic view than the market as a whole. And they're going to be very conscious that in the US has now been in the longest period of continuous expansion since records began in the mid-19th century. And the last decade was the first since the Second World War not to experience a major global recession in the major economies. And I think regulators will also be very aware that previous late or later cycle phases have been just the time when excessive risk has been taken on and unsustainable or unacceptable business models and practices have emerged, with often disastrous results, unfortunately. So I think through comprehensive stress and scenario testing, especially, the regulators will want, and I think very rightly in my view, at least to challenge firms hard as to whether they are prepared for and indeed can withstand any major downturn or any eruption of market turbulence. But they want to do so in a way that ensures that the responses firms would bring to bear on those sort of events would not unleash a fresh round of poor consumer outcomes or consumer detriment.
And David, same question to you about picking your most challenging trend for 2020, but perhaps more thinking about something difficult from the perspective of financial services firms themselves.
Okay, so stepping back from the detail, and as always, there is a lot of detail in our regulator outlook, it strikes me that the biggest challenge remains the sheer volume of regulatory change on the horizon. We're more than 10 years on from the onset of the great financial crisis, and while the vast majority of the global rulemaking has been done, there's still, particularly in Europe, quite a long tail of bank capital regulation that has yet to be implemented. So you have that legacy from the crisis that still needs to be implemented over the coming 2, 3, 4 years. But then looking ahead, as we set out in the Outlook and talked about today, there's a lot coming down the track, and much of it in much less well-charted regulatory territory, much less familiar regulatory territory, affecting and driven by issues such as climate change, technology, artificial intelligence, which is, I think, demanding a much more original response than some of the other regulatory responses that we've seen. And against that background, I think that firms that scan the horizon carefully, join up the dots between these different regulatory initiatives where there are relevant connections, and then go on to implement them smartly and effectively, will be a much better place to deal with them. But really looking ahead, and sorry to end on a somewhat pessimistic and downbeat note, I think there is still a huge regulatory implementation job to be done.
Okay, David, Andrew, Ian, thanks so much for coming on the show.
Great pleasure, Scott. Thank you.
Thanks very much, Scott.
Thank you, Scott.
And there it is, a lot to think about as we take our first steps into what could just be the first few days of the Roaring Twenties. One of the things that I've taken away from the conversation with David, Andrew, and Ian today is just how vulnerable even the best laid plans are to major trends that are shaping our world. Whatever financial sector leaders and regulators might plan to do in 2020, it's clear that they're going to have to adjust as we all learn to respond to how our politics, society, technology, and environment are changing. Now remember, if you like the show, hit the subscribe button to ensure you receive notifications about new episodes. And if you're already subscribed, you can give us a review on your platform of choice or email us with your thoughts at regulatedраdio@deloitte.co.uk. We would love to hear from you. And don't forget, if you listen to the podcast and think this is brilliant, then do us a big favor and recommend the show to a friend or a colleague. You know, and they know, that podcasts are the best new addition to a new decade. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.